Joining us now with more reaction to the Fed and to the press conference is Lukasz Tomicki, LRT Capital Management Founder and Managing Partner. Lukasz, thank you for joining us. So, Jay Powell being pretty firm there, leaving the door open, but being relatively firm that March is not when we're going to get a cut. What do you make of that statement from the press conference?
Good afternoon, and thanks for having me. I think the Fed really wants to cut rates, and they want to cut as soon as they possibly can. And to me, this sounds like desperate talk of trying to look strong and puff up their chest, how they feel very confident they're going to deliver on inflation for the American people. But I think the reality is they have real estate and private equity friends of theirs calling them 5 times a day, begging for lower rates.
Lukasz, what is that based on, though? What are you drawing that conclusion from? Because that's not what the words that were said in the press conference today indicated. And if they wanted to cut rates, why aren't they cutting rates?
He set a very low bar for cutting interest rates. More of the same data for a few more months. And we have to remember that the Fed works primarily from market expectations, not just what happens to the Fed funds rate. Since October, the long part of the yield curve has come in by 100 basis points, and we've had incredible tightening in bond spreads. So there's already loosening financial conditions that are feeding through to the economy. Whether or not they cut actually in March or in May, I think that's a little less relevant. But all the bias is towards cutting rates now. They've been very clear that we've hit peak rates, and they've said more of the same data will mean we cut rates, or a weakening in the labor market would mean the same.
Well, Lukasz, when I listened to Jay Powell, he was saying, listen, I've got to get the inflation back to target. And he was very clear in emphasizing, I don't mean just tapping that target, I mean holding there. When do you think that occurs? I mean, hitting 2% and staying at 2%, Lukasz? Is that in the next quarter, 6 months, 12 months?
We're already there. The data for the last 6 months is already showing you inflation below 2%. Now we're just talking about lapping the year so they have more confidence in that data. And forward-looking alternative measures of CPI, such as Trueflation or the CPI Nowcast, are already printing inflation below 2%. Again, they've set a very low bar. They're going to walk over it fairly soon.
Is there anything wrong with that? I mean, the way you paint this, Lukasz, you sort of make it sound a little nefarious, that the Fed is getting these calls. What are the dangers with it starting to cut sometime soon?
Well, I do think there's a danger of reaccelerating inflation at some point and potentially reigniting, call it animal spirits. The reality is that markets can move very far, very fast, even without fundamental data. So it is entirely possible that we return to a bubble-like territory like we've had in 2021. For the real economy, the real issue, I think, is housing, and the fact that housing remains so unaffordable and so out of reach for many people. But it's very hard to see what the Fed can really do. They can try to crash the housing market or crash the economy, but that's also not good for anyone. So no, I don't mean to make it sound nefarious that they're getting calls, but I think there's an understanding that everyone requires lower interest rates, and the real estate industry in particular.
Lukasz, I want to get you out of here on this. Given your take on the Fed, rates, inflation, what are the investment implications, Lukasz, for you in the equity market?
So we don't like to bet on bubbles, but I think that's probably where we're heading. We're heading to a Momo, melt up, if you will, if my expectations of at least 4 to 6 interest rate cuts in the next 18 months come true. So we don't like to bet on those kind of bubble outcomes. What I think is a much safer outcome, and where we're increasingly putting money in, is the energy sector, which has done absolutely nothing for the last 12 months, and where I think valuations are actually still very reasonable and quite low. And if we do get a reacceleration in the economy and lower interest rates with the low global inventories that we're having in the energy space, it's very easy for oil to run up and for money to finally rotate back into that sector.
Lukasz, thank you so much. Good to have your perspective here today. Appreciate it.
Thank you.